Charities producing theatrical productions, orchestral concerts, or museum or gallery exhibitions are processing their creative tax relief claim through the charity itself, rather than through a separate production company, and that's quietly costing them a significant part of what they're entitled to. Theatre tax relief, orchestra tax relief, and museums and galleries exhibition tax relief all work by adding an extra layer of enhanced expenditure on top of your production costs. If a production is loss-making, that additional expenditure increases the taxable loss, and HMRC will pay out a cash credit based on the full amount of enhanced expenditure. Ideally, you would want the cash-in rate, as it is worth more than the corporate tax savings. For example, the rate for a touring theatre production is worth 45% of the enhanced expenditure, compared to the standard 25% corporation tax rate saving. The specific cash-in rates depend on the scheme and whether you're touring. But if the production is profit-making, the additional relief gets offset against the profit instead. As a charity is typically exempt from paying corporation tax, they won't pay anything, and more importantly, the charity gets no cash benefit from the claim at all. Let's take 3 touring theatre productions with the same £100,000 of core qualifying UK spend and the same £80,000 of enhanced expenditure, i.e. 80% of their qualifying spend. Production 1 runs at a loss before relief, so the enhanced expenditure adds to that loss and the charity receives a payable credit of 45% of this loss, or £36,000. Production 2 makes a small profit of £20,000, which is smaller than the £80,000 of relief. Once the relief is applied, you end up in a taxable loss position of £60,000 that can be surrendered for a cash credit. So in this case, the charity only receives £27,000. Production 3 makes a larger profit of £100,000. After the relief is applied, there's still a taxable profit left over of £20,000. And because the charity is exempt from paying corporation tax, there's no tax saving to offset either. Production 3 generates zero cash benefit from making a claim. This is where a special purpose vehicle, or SPV, changes the picture. An SPV is a separate production company responsible for producing, running, and closing the productions. It typically sits underneath an incorporated charity and is registered for corporation tax. It incurs the production costs and charges a commissioning fee to the charity to cover the costs. The productions therefore operate at a break-even, which means in every case you receive the full cash benefit. Here's how it works. The charity provides a small working capital loan to the production company to allow it to begin trading. The production company pays for staff, contractors, and suppliers and invoices the charity a commissioning fee that balances its costs, keeping the SPV close to break-even and therefore having no impact on the charity. The SPV then claims the relief in its own right, receives the payment from HMRC, and gifts it to the charity. If you run all 3 productions through SPVs, they all behave like Production 1. Production 3, which generated nothing inside the profitable charity, now qualifies for the full £36,000 credit because its trading position is break-even. Setting up the SPV with the correct agreements in place is critical. The key document is a production agreement, which sets out the responsibility for producing, running, and closing. You'll also need an economic pricing policy so costs between the charity and the SPV are priced at economic cost, as well as a management and services agreement covering anything the charity provides to the production company, and the commissioning fee mechanism. HMRC has every right to ask to see this documentation, so it needs to be correct from the outset. This is exactly what Myriad helps charities put in place: structuring the SPV correctly, drafting the legal documents, handling the economic pricing, managing the bookkeeping and statutory accounts, and, of course, preparing the claim itself, trade by trade, so HMRC accepts it without pushback. If your charity is currently claiming creative tax relief through the parent organisation rather than an SPV, get in touch and we'll show you exactly what you could be missing.